This is the logic XRP investors don't understand. The question isn't whether XRP is useful today. The question is whether the current system can survive without something like XRP tomorrow. Predicting its success requires predicting failure, not of XRP, but of global liquidity structures. That means inflation cycles, debt burdens, weakening sovereign currencies, and a world where cross-border finance must evolve or break. If I follow the data, I don't see a system prepared for the rising wave of digital finance needs. Cross-border transactions are projected to surpass $290 trillion annually in the coming decade. Regulatory requirements are tightening. Capital controls are increasing, not shrinking. Sovereign currencies are growing weaker, while digital alternatives grow stronger. If governments cannot stabilize their traditional currencies, they will need systems that increase international liquidity, not decrease it. Technology won't be a luxury, it will be a lifeboat, and systems that reduce friction become mandatory. This brings me to a key observation. XRP is not a retail product. Speculators trade it, but they are not the intended buyers. XRP was built for institutions. Retail investors are placeholders, the early liquidity that keeps the system alive until the real players arrive. But the problem is that most retail investors expect speculative profits based on the same institutions who don't yet need XRP. They are waiting for adoption without understanding what triggers adoption. They believe it will happen because the technology exists, instead of because the system fails. Technology never leads. Crisis leads. Technology follows crisis and becomes the solution after the damage. That's where acceleration happens, where change becomes mandatory. So if XRP is an institutional asset waiting for crisis, then its timeline doesn't follow crypto cycles. It follows macroeconomic instability. This means most investors are impatient for the wrong reasons. They expect sudden growth in a world that has not yet demanded XRP's use case. They are measuring its value based on speculation instead of fragility in the existing system. A contrarian investor should measure the timing of global risk. The higher the stress in the system, the closer XRP moves to relevance. That is what matters, not community hype, not predictions about price targets. What matters is whether the global financial system will break fast enough for XRP to become needed. The data suggests growing stress, government debts increasing, currency devaluation spreading, regulatory frameworks expanding, pressure building. But pressure doesn't equal collapse, it equals slow deterioration until a tipping point. And tipping points are impossible to time, but inevitable. Most people misunderstand XRP because they approach it like a trader, not like an analyst studying financial infrastructure. When someone looks at XRP and asks whether its price will go up or down, they reveal that they don't understand what XRP is built for. The fundamental mistake is assuming that XRP is a consumer product designed for speculation. In reality, it is the opposite. XRP was not designed for ordinary retail investors, and it was never meant to become a popular currency used in everyday transactions. The true purpose of XRP lies in the world of large-scale financial institutions. It is built to solve a specific problem that only corporations and banks face: the inefficiency, delay, and cost of cross-border settlements. That is not something individuals deal with directly. People only interact with the end result. They never see the infrastructure behind the system. XRP is that potential infrastructure. Retail traders provide early liquidity and market presence, but they are not the intended end users. Speculators behave like they are the center of XRP's future, even though they are temporary occupants in a market that is waiting for institutional adoption. When retail investors talk about XRP reaching astronomical price levels based on hype or public attention, they are using a consumer mindset to judge a tool that has nothing to do with consumer behavior. The paradox is that the more people demand retail use cases, the less they understand XRP. An asset built to operate behind the scenes will not succeed by becoming a popular product. It will succeed by becoming invisible, integrated into the financial system in a way that no ordinary person ever sees or thinks about. Just like how most people don't know how SWIFT actually works, they won't need to know what XRP does. They will only benefit from the efficiency and speed it brings. The reason this misunderstanding persists is that traders and influencers confuse usage with exposure. They believe that for XRP to be successful, people need to talk about it, advertise it, and use it directly like a currency. But institutional tools don't work that way. Banks don't choose systems because of hype, community support, or predictions on YouTube. Financial institutions choose systems based on cost savings, regulatory compliance, liquidity needs, and settlement reliability. XRP's value proposition sits entirely in those areas. Its role is to serve as a bridge asset that moves money across different systems in a way that reduces friction. That task doesn't require public excitement. It requires institutional necessity. However, this also means retail investors must change their expectations. If someone buys XRP expecting public mass adoption like a fashionable payment method, they are betting on the wrong outcome. The true thesis is that XRP has the potential to be absorbed into the financial sector's internal functioning, and if it does, the price will not rise because millions of people buy coffee with it. It will rise because trillions of dollars of institutional settlements will demand liquidity through it. The scale difference is not just large, it is transformative. The daily consumer market cannot compare to the global settlement market. Speculators today are like early witnesses to a technology that they don't fully understand. They mistake their temporary participation for long-term design. XRP's future is not built on their enthusiasm. It is built on systemic need. The irony is that if XRP succeeds, the people who believe it requires hype will disappear from the conversation, and the asset will quietly do exactly what it was built to do, not to entertain the market, but to invisibly support it. Burr. People talk about the future of XRP. They usually focus on excitement, hype cycles, social media predictions, or upcoming partnerships. They expect that adoption will come from growing popularity, increasing awareness, or a sudden decision by banks to embrace new technology. This belief assumes that progress in finance is driven by enthusiasm. But the financial sector has never worked that way. Innovation in global banking does not happen because people like a technology or because speculation increases its price. Real transformation in finance emerges from necessity, usually in response to failure. So if someone wants to understand when XRP might rise, they should not measure excitement or marketing momentum. They should study the point at which the current system becomes too weak to continue without help. XRP's success is not triggered by people wanting it, but by the global system needing it. The present financial infrastructure is slow, expensive, and highly dependent on outdated settlement mechanisms that are decades old. Yet banks and governments tolerate it because inefficiency is still manageable. As long as the system is functional enough to keep liquidity moving, there is no incentive to replace it. This means XRP will not become widely used simply because it is a superior solution. History proves that superior technologies often wait years, sometimes decades, before necessity forces adoption. The airline industry didn't upgrade to safer materials because they were available. It upgraded after accidents exposed weaknesses. Modern cybersecurity systems weren't implemented when the technology first existed. They were implemented after catastrophic breaches. The same pattern applies to global finance. The faster settlement and cost efficiency offered by XRP won't be needed until the current system breaks down under economic pressure. Technology follows crisis. It does not lead it. At the moment, the banking sector is operating under heavy strain. Debt levels are rising. Central banks are struggling with inflation control. Currencies are weakening. And cross-border money movement is more complicated due to tighter regulations and geopolitical tensions. Yet the system continues to function, even if imperfectly. It is like an aging bridge that still stands. People ignore its weaknesses until a critical crack appears. No one invests in a replacement structure until collapse becomes a real possibility. In the same way, XRP will only become essential when the world reaches a tipping point, when inefficiency in settlement becomes too costly, when liquidity risks become too severe, and when governments demand transparency that current systems cannot provide. At that point, a solution won't be a choice. It will be mandatory. This is why projecting XRP's timeline based on speculation misses the larger picture. It is irrelevant whether traders expect it to rise in a particular year. The timeline does not depend on opinions. It depends on global financial stress. The higher the instability in currencies, regulations, and debt structures, the closer the world moves toward needing a settlement solution that is fast, reliable, and independent of national currencies. If the global system deteriorates gradually, XRP adoption may take time. If it faces a sudden crisis, adoption could accelerate overnight. Investors who expect smooth growth misunderstand the type of asset they are dealing with. XRP is built for emergencies, not trends. Understanding this can change how someone invests. Instead of expecting explosive gains due to hype cycles, they should watch for breakdowns in global liquidity, rising settlement costs, worsening debt conditions, or the increasing push for transparent and regulated payment systems. XRP becomes valuable when the old system stops working. That is the key. Its growth is not driven by market excitement, but by structural failure. The question is not whether XRP will explode because PLE are optimistic, but whether the world will eventually have no better option. When that moment arrives, speculation will no longer matter. Necessity will take over, and adoption will not be gradual. It will be inevitable. One of the most misunderstood ideas in crypto investing is the assumption that banks are waiting eagerly for faster, cheaper payment systems. People imagine that financial institutions are desperate for speed, as if delays frustrate them the same way waiting for a slow transaction annoys a retail user. The truth is the opposite. Banks profit from delay. The settlement lag in cross-border transactions is not a flaw. It is a hidden source of revenue. When a transaction takes days to clear, money does not simply sit idle. It moves through internal liquidity pools, earns interest, affects exchange rate spreads, and gives institutions time to balance their books. That time window is an asset. The inefficiency the public complains about is a financial advantage for banks, and XRP, with its promise of instant settlement, threatens that advantage. The current global payment system is built on intermediaries, nostro accounts, correspondent banks, delayed confirmation, and reconciliation periods. These features look outdated to the average person, but to banks they function like a liquidity cushion. Imagine a store that promises you can return a product after 7 days, and during those 7 days it collects interest on the cash you paid. The delay is not a bug, it is part of the business model. Similarly, the slow time between sending money internationally and final settlement allows banks to earn from currency fluctuations, manage liquidity risk, and protect themselves from sudden financial shocks. If settlement becomes instantaneous, that buffer disappears. Banks lose control over how they handle liquidity. Instant money movement sounds beneficial. For banks, it removes a protective layer. So why would they voluntarily adopt something like XRP? They wouldn't, not unless the cost of inefficiency becomes greater than the profit they gain from delay. The only reason a bank would shift to instant settlement is if regulations force transparency, if global crises increase the need for liquidity, or if inefficiencies begin to threaten stability. Until that point, XRP looks like a threat, not a solution. This is the main reason many outsiders are confused about why mass adoption hasn't happened yet. They think banks should choose the best technology immediately, but banking does not reward better technology. It rewards stability, control, and predictable revenue. Only when an existing system becomes unmanageable or unprofitable do banks replace it. In this context, XRP is like a tool that is too efficient for today's environment. It is ahead of its time. It offers a level of speed that undermines how banks currently protect themselves and make money, but that does not mean XRP is useless. It means its use case depends on larger forces that will eventually reshape the system. When liquidity pressures rise, when regulations demand instant traceability, when capital restrictions tighten, and when delays become too risky, XRP will shift from being a threat to being a necessity. The timing depends on macroeconomic stress, not technology. XRP is essentially waiting for the world to change. This also exposes a deeper misunderstanding among investors who expect institutions to suddenly flip the switch and adopt instant settlement. Adoption is not a choice driven by innovation, it is a reaction to survival. Banks will not integrate XRP because it is faster. They will do it when they no longer have the luxury of slow settlement, when their buffer turns into a liability instead of an advantage. This is why XRP's real growth potential lies in crisis conditions. When the system becomes fragile, efficiency becomes profitable. When inefficiency puts banks at risk, instant settlement stops being a threat. So if someone truly wants to predict XRP's future, they should not analyze which companies are partnering or what announcements are made. They should analyze how much pressure the banking system is under, how unstable global liquidity is becoming, and how much longer banks can profit from delay without exposing themselves to risk. The moment the cost of inefficiency becomes greater than the value of control, XRP will no longer be an outsider. It will become the structural foundation that institutions must rely on. That shift will not happen because they want it, but because they have no choice. The strength of XRP does not come from excitement, speculation, or even innovation alone. Its potential grows quietly in the background as the global financial environment becomes more fragile. Most people look at XRP's price chart to judge its future, but charts are only reflections of sentiment. The real driver of XRP's destiny is systemic instability. As currencies weaken, as debt grows unsustainably, as regulations tighten, and as international liquidity becomes harder to maintain, the world unknowingly prepares space for a technology that can resolve settlement pressure. In other words, XRP does not rise when people believe in it. It rises when global finance stops functioning efficiently enough to survive without it. That shift is not emotional, speculative, or hype-driven. It is mechanical. Systems under stress always seek the most efficient escape path. The current global setup is a fragile balance held together with outdated tools. Central banks fight inflation by tightening monetary policy, yet tightening weakens small economies and reduces liquidity in international markets. Governments increase regulations to protect financial systems, but those same regulations slow settlement processes and make it harder for institutions to move capital freely. At the same time, cross-border trade keeps growing, meaning more money needs to move in a world where it is becoming harder to move it. The old infrastructure is being asked to handle more volume under tighter rules with lower liquidity. It is similar to forcing a narrow pipe to handle increasing water pressure year after year. Eventually, the pipe bursts or needs replacement. XRP represents a larger pressure-resistant pipe. In that sense, XRP's value is tied to instability rather than growth. When currencies begin to fail or lose purchasing power, governments seek solutions that allow them to maintain global trade without depending on unstable local money. When banks face liquidity shortages, they need settlement tools that don't require billions of collateral sitting idle. When regulations demand transparency, they require systems that can produce instant verifiable data. The more problems grow, the more XRP becomes relevant because it is one of the few tools engineered for all three needs: strong liquidity efficiency, neutrality across borders, and instant traceable settlement. It is not merely technology, it is infrastructure designed for a world under stress. Most investors miss this connection because they assume technology adoption follows enthusiasm. They believe improvements are adopted when they become available. But history shows the opposite. Nations adopt new financial systems when old ones become too painful to maintain. Paper money replaced metal coins not because people preferred paper, but because governments faced shortages of metal during wars and trade imbalance. Electronic banking grew rapidly not because the public demanded it, but because governments needed cheaper ways to process growing transaction volume. The pattern is clear: necessity drives transformation. The same logic applies to XRP. The increasing fragility of global finance is the pressure that eventually forces adoption. The bigger the crisis, the faster the shift. This is why volatility, inflation, regulatory crackdowns, liquidity shortages, and geopolitical conflicts are not threats to XRP's existence. They are the conditions that push it into relevance. Each instability is a crack forming in an old structure. The timing cannot be predicted by market speculation because speculation follows excitement while infrastructure follows collapse. XRP investors who focus solely on news headlines or price movements are looking in the wrong direction. The asset's true future will be decided in meetings between governments restructuring policy, central banks managing failing liquidity, corporations under regulatory pressure, and institutions searching for a neutral financial rail that reduces risk. In those conversations, hype does not matter. Necessity does. If the global financial environment remains stable, XRP's adoption will be slow. If instability accelerates, adoption will accelerate with it. Its value is not built on how many people buy it, but on how badly the world needs what it provides. The more the system struggles, the more likely the world is to turn toward a settlement infrastructure that can bypass inefficiency without destabilizing governments or giving full control to any one nation. XRP becomes strongest when the world becomes weakest, and that dynamic is the foundation of its potential. Many people falsely categorize XRP as a cryptocurrency competing with national currencies, payment apps, or consumer financial tools. They treat it as if its purpose is to replace the money people use every day, like a digital version of cash competing with traditional currencies. That assumption leads to shallow predictions, unrealistic expectations, and noisy debates. The reality is far simpler and more strategic. XRP is designed to function as a bridge, not a destination. It does not seek to replace money. It seeks to move money. This distinction is critical. Replacing currency means challenging governments, central banks, and national monetary policy. No serious institutional asset attempts that. But acting as a neutral bridge between currencies avoids conflict, increases efficiency, and opens a path to adoption without a political battle. In financial systems, the power is not held by the currency itself, but by the infrastructure that dictates how liquidity flows. Consider how airports function. Airplanes belong to many countries and airlines, but every plane needs airports to land and take off. The airport doesn't compete with airlines, nor does it replace them. It serves as the infrastructure that makes flight possible. The value of an airport is not measured by how many people talk about it or how famous it is. Its value comes from necessity. Every flight depends on it. XRP has similar potential. It does not ask nations to abandon their monetary systems. It offers a pathway for those systems to interact more efficiently. It allows different currencies to settle instantly without forcing them to merge, compete, or trust one single government. That neutrality is its competitive edge. Most cryptocurrencies try to replace or reinvent money. That creates a direct conflict with regulators and governments who must defend their monetary authority. XRP, on the other hand, proposes a supporting role. It acts as a translator between currencies. It makes liquidity portable, transportable, and interchangeable without needing the currencies themselves to lose control. It offers an answer to a problem no nation has solved: how to move money globally at low cost without sacrificing sovereignty or transparency. This is why XRP's potential lies not in popularity but in invisibility. The best infrastructures are not seen. People use them every day without noticing them. They do not ask who runs the internet cables beneath the ocean, but those cables remain essential for global communication. If XRP succeeds, it will disappear from public conversation, not because it failed, but because it became part of financial plumbing that no longer needs attention. This is what most investors miss. They want XRP to be visible, dominant, talked about constantly, and celebrated as the future of money. But assets that become infrastructure do not need celebration. They need stability, regulation, adoption by institutions, and acceptance as a standard. Public attention can actually become a distraction. If investors expect mass consumer usage, they are betting on the wrong fate. XRP does not need people to buy groceries with it. It needs institutions to move trillions through it. Its scale is institutional, not retail. When trillions move, price adjusts naturally. Liquidity demand becomes the driver. Retail demand becomes irrelevant. Infrastructure assets grow in value through usage, not advertisement. The strongest financial tools are not the ones individuals talk about, but the ones institutions rely on. Investors who expect visibility as a sign of adoption are looking at wrong signals. Real adoption will appear through quiet integration, regulatory acceptance, and increasing settlement volume. XRP's future is not to become a currency everyone holds. Its future is to become the structure through which currencies travel. That role is subtle, yet powerful. The bridge becomes valuable, not by competing with what crosses it, but by being the only path that traffic depends on.